Hi there, folks. It's James Marley here, co-founder of Livewire Markets. And in what is becoming a regular feature of reporting season is a chat with Rudi Filapek-Vandyck, who's the editor at FN Arena. Many of you will know Rudi because he publishes regularly on Livewire and other websites, his own website, of course. And he's a great follower of the markets, a great source of knowledge and expertise. And I really enjoy getting a chat with him every reporting season. On Livewire this reporting season, he'll be publishing his weekly reporting season monitor, which is an awesome bit of work that keeps you up to date with how all the different companies have reported, what the brokers thought about their reports, whether it was an upgrade or a downgrade. So I'll put a link to that in the bottom of the wire and also on YouTube. But Rudi, very warm welcome to you. Great to catch up again, and thanks for making some time for me this afternoon.
Oh, my pleasure. But I mean, I'm usually the guy who likes to break traditions, but in this case, let's keep this one going. And I mean, obviously, I'll do my best in sharing everything I know in advance of the reporting season.
Get out your crystal ball. Well, last time we spoke, which was prior to the past reporting season, or maybe just after it, from memory, you said we're in the healthiest bull market that we've seen in years, and from that, I take that. Corporate balance sheets were in amazing shape and should be able to withstand just about anything the market wants to throw at them. Yet the prospect of higher inflation and rising rates, and we've all got the jitters again. So my question to you is your thesis about the bull market still intact?
How times change, how quickly they can change, huh? I mean, that statement was made in an environment where central banks were still supportive. Governments were still supportive. Earnings growth was pretty strong globally, and not to be dismissed. And that's one of the reasons why I used that statement at the time. Earnings forecasts were still rising, and if you combine all of that together, then it turns out, even though valuations were not on the cheap side last year, it was way too early to get overly bearish or negative. But of course, now that we've moved into 2020, and it's the obvious observation to make, things have changed. Dynamics have really changed. And one of the things that's changed in Australia, and that's obviously something we pay attention to, is that earnings forecasts are no longer providing support for the market as a whole. And they're supporting, at the moment, they're supporting the commodity side of the market in Australia, but not so much the rest of the market. And from that perspective, February will be key, if not all important, for the direction of the market. In the US, of course, we are seeing the same effect. Earnings forecasts are not necessarily providing more and more incentives for investors to keep on buying stocks that have already performed very well. So we have a different environment this year. The big unknown is that we'll have a liquidity withdrawal this year. And last year, of course, we didn't have that, and we have had many years now of positive support from liquidity. And that's a process that we have to go through. We don't know exactly how that is going to pan out, but I would wager that the strong downdraft in cryptocurrencies, in small cap and micro cap stocks, and the riskier end of the technology sector and in the technology sector in general, I think that is probably related, not exclusively, but probably related to a general anticipation of a withdrawal of liquidity in markets in general.
Rudi, I'm interested. There's sort of two parts to the equation there. One is the removal of liquidity, and ironically, it feels like we've been talking about this. We spent all of 2021 talking about that this was coming, and inflation, and everyone knew about it. We all got sick to death of talking about inflation, yet it was really only until the last quarter, even January, when the markets decided to take note of it, given we've been talking about it the whole time. So I guess that's one part of it. How much of a catalyst has been the rising rate talk and that withdrawal of liquidity been, versus what you touched on at the start, which is declining earnings expectations or slowing growth?
In a general sense, I think if I go back to what the market expectations actually are with inflation, and if I want to make a joke about it, we're all inflation experts in 2022 and last year as well. But if I want to come back to what the general underlying expectation is that inflation is globally probably peaking in the first quarter of this year, and then will then come down. The pace of where it will come down is pretty much related to the fact for how quickly and how harsh the central bankers will react and respond to it. Why we have this volatility this year is not because anything has changed dramatically with inflation. What has changed is the central bankers have changed. Until December, they seemed to be pretty sanguine about it and taking their time and trying to calm the market, and nothing was going to happen. And all of a sudden, the Federal Reserve and now the ECB as well, they've basically lost their cool a little bit. And what you get then is then obviously the market gets a bit of a scare, gets a bit of a shock. What is happening in the background is that if large investors have to reallocate their portfolios, that is usually quite of a distinguished impact on markets, and that's what we basically see. And what you then get is indiscriminate selling, essentially. And of course, usually what happens is that the sector that was previously very, very popular and has performed quite well, and everyone is positioned in those stocks, they feel the hardest impact. And that's quite very simply the high PE stocks, the high growth stocks, and everything that has a technology label attached to it. There's two ways that investors can respond to this. One is if there's indiscriminate selling, it's probably time to start distinguishing the better quality from the lower quality ones. And as always happens, markets will push this too far, and there will be opportunities. But, and this is important as well, you need cash to jump on those opportunities. So I think it's good not to dismiss everything that is now growth, quality, defensive, and technology by default, but you need cash to jump on those opportunities as well. So I think this reporting season will become extremely interesting within that context.
Rudy, what have you done with your own portfolio? Have you come into this reporting season holding higher or lower levels of cash than you traditionally would have? And what sort of levels do you hold?
Yes, I've significantly increased my cash holdings, quite significantly. And of course, I mean, when the downdrafts come, you never have enough in cash. And that's just how these things go, essentially. There's a couple of reasons why I've done this, and it's not just related to the reporting season, but the reporting season definitely plays a major role into this. The risks, I mean, when I returned in early January and I had a look at the market and I started thinking about what might potentially happen, I was really taken aback myself a little bit by how much risk there is actually out there now. And I think we should all not casually dismiss the risks that we are facing in 2022. The fact that bond yields are moving higher and then central bankers are raising interest rates, that's only part of the occasion. And that's the main item that the market's now trying to take into account. But further down the track, we will have slowing economic growth globally, not necessarily in Australia, but Australia will then be facing a decelerating housing market, probably falling property prices. And that's a dynamic that we will have to deal with beyond the rising bond yields and interest rate scares that are happening right now. So it's by default, you can count on this one. It's going to be very volatile this year. We moved into 2022 with a little bit excess happening. I think that excess was happening more in the United States than in Australia. But we have had pockets in Australia where money was simply flowing in because the share price was going up, essentially. And that has now been punished very harshly, and that's probably a good thing. The other thing that we constantly have in this market, it's very polarized, and a lot of value investors have been complaining for years that their stocks simply don't want to move. That's essentially not a good thing for markets either. So if that becomes more balanced this year, that's a good thing, theoretically and academically. But it will mean that, of course, that a lot of volatility and there will be a lot of money will go lost, and a lot of investors will get some really harsh lessons. How the market can be a very harsh mistress at times after being so comfortable and so accommodating over the past year and a half or so. So if I look at the geopolitical spectrum as well, I mean, we should not underestimate that there's a lot of bad news that can come from the oil price and from maybe a conflict between Russia and the West in the Ukraine, and China and the West in Taiwan. And for the very first time, I realized that we might actually face some really bad news on those fronts, where the powers that be in today's world might find themselves on opposite sides of a military conflict. And that's something you and I and most investors haven't seen for quite a while. And markets have been so far quite sanguine about this, but it is a risk, and it is a tangible risk that at some stage can come to the fore. At the moment, we're dealing with interest rate hikes and with bond yields. We will start dealing with slowing corporate growth and slowing economic growth a little bit further down the track. And as far as the reporting season goes, the whole inflation debate is predominantly focused on where are bond yields heading and how will governments and central banks respond to it. But what has gone a little bit lost in that discussion is how this impacts on corporate life. And long story short, what we are seeing this year in ahead of the February reporting season is something that we haven't seen for quite a while. We have profit warnings, corporate profit warnings, and quite a number. I mean, not as much as we had in 2019, but still, it's pronounced. I mean, some of the share prices have absolutely been smashed as a result, and it also shows you that the so-called inflation protection through buying commodity producers is in itself quite a flawed concept as well, because many of those producers have disappointed with their quarterly production reports. And then those share prices, of course, go down as well. So if you combine all of this together, I thought that the risk was quite high. And I all of a sudden found myself in a position that I cannot predict which company exactly in the portfolio or not or otherwise will not be punished in February. And I thought for that reason as well, I thought it was best to have cash on the sidelines. So I can actually reallocate as the reporting season develops, and also as the market as reassessments of the outlook develops.
Rudy, we've sort of been there before. 15 months or so ago, we saw a pulse put into the value trade, and it had its time in the sun, and then it reversed quite quickly, and everyone was enamored with growth and some of those higher PE, higher multiple, higher risk names. Do you feel like the scenario has changed this time because the backdrop around rising interest rates and slowing growth that we discussed earlier on, or do you think this is potentially a good opportunity to a genuine swing towards the value stocks?
It's a bit of both. First observation, you're right. We have over the past 5-6 years, we have seen a couple of times that the market tried to swing into the value end. The second part of 2016 comes to mind. The first part of 2019 comes to mind, and then obviously, of course, October, November 2020. On no occasion has it lasted for a very long time, weeks, few months at most. and the market has continuously swung back into the growth and the quality end. I think what is changing, what is likely to change from here onwards, is that we're not going to do it as a sector thing anymore. I think it's not going to be, as long as your healthcare or technology you're going to buy. I think the market investors will be more discriminate now. But I do believe that the quality stocks in those sectors will at some point, I mean, exact timing unknown, but they will at some point come to the fore again, and they will be bought again. And investors will learn a valuable lesson here, that there is value, so to speak, in sorting out the higher quality ones, the ones that are generally carried by multi-year growth outlooks, by mega trends, and by good balance sheets, cash generation, quality management, and all of that. Those companies will again come to the fore, and it would be not very smart to casually dismiss them now that we are at the peak of market change and concentration on rising bond yields and central bank actions. I mean, I'm happy to throw in a handful of names. I mean, the likes of Ariego, which we already mentioned, ResMed, Breville Group, car sales, Seek. I mean, those companies, NextDC, Pro Medicus, those are. I mean, even Zero should be in there. Those are, in their own right, quite exceptional business models in Australia. I mean, and it's just that, yes, some of them have maybe become a little bit bloated in the share price last year, but they all else being equal, they should have multi-years of strong growth ahead of them, quite reliable, defensible, predictable, and at some stage those companies sold off in every market switch that we have seen over the years. 2018, 2019, 2020, but every time they keep coming back, and they will come back, but maybe not necessarily tomorrow.
Rudy, I've asked you to give me your top 5 stocks to follow this reporting season. So I thought maybe we could. I've got one more question after this, but I was wondering if you could give me the top 5 stocks that you're going to be watching, that you think are really interesting to keep an eye on this reporting season.
Yeah. Let me start by saying that there are more ways of making money than simply buying companies that surprise to the upside in reporting season. I think one of the strategies and one of the things that will increasingly come to the fore this season, I think, is asset sales. And a lot of laggards have started to consider, started actively working on the sales of parts or whole of assets, and then giving money back to shareholders. And I think an excellent example of how that strategy can benefit shareholders, I think, is Telstra. And I mean, it's been a very long time since I mentioned Telstra in a positive framework, but I think this is one of those times when that is justified. And for full disclosure, I own the shares and have owned the shares since, from memory, January last year. And see, from the moment that the share price was around $3, it has over the year gone to $4. And I think over this year, it may well go to $5, all else being equal. And obviously, that depends on the length of the bear market as well. But and why is that? Why did I buy Telstra in January 2021? It's because I picked up that they were going to revise the strategy and they were going to sell assets. And that, of course, brings out the value that the share market doesn't want to put in that company on the normal operational performance. And obviously, bad sentiment, bad past, bad track record, you name it. But it is a way of turning fortunes around. And if you take that example, you see, for example, Origin Energy has started to sell part of its assets, and its speculation is they're gonna announce a special dividend this February, And of course, one of the obvious examples is News Corp. I mean, a share price that everyone keeps telling investors heavily undervalued. You would expect that they are working internally on getting that value to shareholders, and it probably implies asset sales. And there will be, if you look at those laggards from that perspective, there will be other examples as well.
I think it's interesting, Rudy, and it's last year there was a lot of capital return to shareholders in the form of dividends, and the other thing that we saw was heightened M&A activity, which showed that money sitting on the sidelines, private equity, whatever it might be, saw that value and sought to pick it up before it got released to other to existing shareholders.
Yeah, absolutely, and the other thing is that the pendulum is swinging towards the laggards part of the market, and that is also because arguably parts of those market laggards, they're now getting ready for having, at the very least, a momentum switch in the operational side, and investors can use, for example, as an example, this week's presentations given by Nufarm, which has been one of those eternal promises that simply didn't deliver over the past decade or so. But now this week, the company really got the community excited. And if they manage to deliver on that 5-year plan they announced, or they communicated this week, then that share price, of course, that looks very attractive. And that's sort of what the change in market dynamic that can happen with the reporting season like we're now seeing in February. But getting back to your question is, I think probably one of the ways of nominating a few companies is, I mean, I obviously have my own portfolio, and I pay attention to what analysts are predicting ahead of the February reporting season. And I picked up that various stocks I own, they're being nominated as a conviction call by investors, not simply as potentially a better than expected result in February, but also as a company that will perform on a year or a 2 years basis, and they are convinced that it will, irrespective of what the share price is doing in the short term. And a couple of companies that come to mind in this perspective, and as I said, I own them. One of them is Breville Group, nominated by quite a number of people saying like it's what's happening in the share price is ridiculous, but that's what you get in indiscriminate selling. Another one would be NextDC, where people still go that the company has nothing to offer. It has no moat. It has nothing special. To which I happily respond with, but the mega trend is so strong, and this is such a solid performer and carried by that mega trend. And people underestimate that if you have to spend almost $1 billion on a new data center, how much of a moat that actually is.
That's to say that capital required is
yes.
Moat.
Yes, exactly. People are also this is for the people who only look at companies on the PE level, of course. There's plenty of people still convinced that Pro Medicus has a very, very profitable future ahead of it. I agree with the fact that this is probably the highest quality growth stock we have of the share market. It doesn't mean, of course, that nothing ever can go wrong around the corner, but I tend to agree that you would want to buy that stock after a big sell-off, and you're never going to get it at a low PE, essentially. I mean, that's just not going to happen.
For those viewers out there, we Livewire actually released a podcast with an interview of the CEO of Pro Medicus, Dr. Sam Hupert, earlier in January, and he talks about the IP and the work and the data and the competitive advantage that they have over their peer group. So if you want to do a deep dive listen on that, it's quite fascinating.
Yes, exactly. And maybe surprisingly so, Wesfarmers is seen as a very solid, even though it's not necessarily trading on cheap valuations here, but it is being regarded as one of those stocks, and not even for the lithium exposure, because that is really not kicking in yet, right? But again, it's one of those companies that just keeps delivering. And another one, because I can't nominate ResMed or Arriego because they already reported, but expectations are very positive for SEEK as well. And the only but you could maybe throw in for some of those companies is, but if bond yields rise much higher, then that might have an impact on their valuation, and that is true. But we don't know whether bond yields go much higher, and if they do, we don't know whether they do that in a straight line. And I think this is one of the problems sometimes with the share market, is that if 10 years ago we would have sat here and I would have said, well, bond yields will go negative, right? And that would have been very scary for some people, but it took so many years to get there. It doesn't go in a straight line. And I think sometimes with where we get very uncomfortable with the share market, we see, like, people make predictions like we go into a new regime of higher inflation. I mean, sounds very scary. But what exactly does it mean? I mean, if it goes to between 2 and 3% on a consistent basis, that is higher inflation than we had over the past decade. It doesn't mean that there's no value in any of the stocks I just mentioned. And that is, I think, often the context it goes a little bit missing when sentiment rules, and sentiment is negative, which it is at this point in time.
But Rudy, if I was to put a wrap around some of your views, it sounds like you're a bit more cautious, a bit more nervous about what the market holds for us in 2022. And as a result, you've raised your cash levels, you've been brutal on the stocks that you're not so high conviction on. But you are definitely seeing some opportunities to add to some of these higher quality growth names that have been sold off. And you're looking at opportunities with companies that might be able to divest some of the assets and return that to shareholders.
Yes, and if I can add something as well, the fact that we are having these bear market dynamics in the market right now, which means high volatility, heavy selling, indiscriminate selling, positive news that's not necessarily translated into positive share price response. It doesn't mean that much. Yeah, the positive news is that bear markets on average last a lot shorter than bull markets, and it doesn't mean that the only way forever and ever is downwards. I mean, what we do not know is when actually the overall climate will change. But if central bankers finally start raising interest rates, and if we see inflation coming down, my suspicion would be that markets might actually be calming down a lot as well. But since none of the two will be appearing next week, we might be having a lot more volatility between now and maybe that point.
Good stuff. Well, Rudy, it's always great to catch up. Thanks for jumping on the line. For all of your viewers out there, as I said, I'll drop the links to Rudy's profile on Livewire, where he'll be publishing his weekly reporting season monitor. And remember to subscribe to the YouTube channel for Livewire. We've got plenty of videos coming up each week. Thanks for watching.